Hey everyone, one of the reasons why I've been so bullish on Alphabet stock here in 2024 is because of the company's concerted efforts to control cost. Still, despite those efforts, the company is investing aggressively in expansion in key categories. That's what I'll discuss in this video. The investments Alphabet is making, how that could impact its cash flow from operations, and whether or not that still makes Alphabet stock an attractive investment for long-term investors. So let's take a look at the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
One of the areas I've been pleased with Alphabet with is its reduction in employee count. Now, in its latest quarter, the headcount decreased even further, which reflects both actions that we have taken in the first half of the year and a much slower pace of hiring. Remember, in early 2023, Alphabet enacted a massive cost-cutting campaign where they let go of tens of thousands of employees. Now, I criticized that effort because of how much it cost the company in severance pay. Alphabet was very generous with the severance packages that it announced along with that cost-cutting campaign, and I suggested maybe it would be better, instead of firing all of those individuals, to just slow your pace of hiring and then through attrition, reduce your employee headcount if you're going to have to pay so much in order to let go of so many employees. Now, when your business is undertaking massive changes, that may not be viable, right? Because you might have employees in one category where you need employees in another category. And so you do need to let go of employees and then hire employees in another area with different skills. And so I understand that fact of this situation. I just was hoping Alphabet would undertake these cost-cutting measures more effectively. Now, they have stated that they're still hiring slowly, but they're saying that they expect a slight increase in headcount in the third quarter as we bring on new graduates. So it looks like these decreases in headcount, which Alphabet has been doing ever since like the first quarter of 2023, it looks like that might be coming to an end. It looks like starting with the third quarter, they're going to be adding to their headcount because they've diminished so increasingly that they now need people because the business has grown since then. Also, remember, they've re-accelerated growth meaningfully since the first quarter of 2023, and now they need more people because they have more business. So that's understandable. And the areas they're hiring, I'm fully on board with, right? They're hiring in the cloud and technical infrastructure, and its cloud business has been thriving. It's the latest business to turn profitable for Alphabet. It generated an operating profit margin of 11%, whereas Alphabet main rival, or one of Alphabet's main rivals, Amazon Web Services, is generating an operating profit margin closer to 30%. And so I understand investing in that category because it's so lucrative and provides so much potential for Alphabet when they reach larger scale. But to reassure investors, Alphabet said that they continue to expect for 2024 their operating margin to expand. So despite the fact that they're investing to grow, they're still going to increase their operating profit margin. So these added costs are not going to bring down profitability because there's going to be increasing revenue to offset those rising costs. So they're not going to spend more than the revenue is coming in, and therefore they're still going to generate operating profit margin expansion. Now, in the third quarter, the operating profit margins will reflect the impact of both of these investments in employees and infrastructure. So the third quarter operating profit margins may not be that great, but it should recover in the fourth quarter. So far, what I've talked about in terms of expenses for Alphabet are just what I said, expenses. The difference between expenses and capital expenditure are that capital expenditures come on long-term assets. So when Alphabet invests in, let's say, a data server or just a server and then an artificial intelligence data center, those are long-term investments. Alphabet invests in these data centers that then depreciate over time. So they're increasing investment both in current expenses like employees, and they're increasing investment in capital expenditure for things like servers and data centers, which are long-term assets. And in that category, they've meaningfully increased investment. So CapEx in the second quarter came in at 13 billion, and that was driven overwhelmingly by investments in technical infrastructure, with the largest component for servers, followed by data centers. And of course, this is to facilitate the growth of its AI capabilities. Given that Alphabet is selling these AI capabilities that are driving significant demand from its customers, it feels like it's a prudent investment to continue expanding in this category. Now, for the rest of the year, the company says that the capex will be at or above $12 billion, and then it'll continue at that rate going forward. Now, I highlighted that Alphabet's investment is great news for NVIDIA stock investors, because when Alphabet is building these data centers and servers, one of the main components in these data centers are NVIDIA's GPUs. And so NVIDIA will be glad to hear that Alphabet is spending this much money every quarter on building data centers and servers, but also that they expect to continue spending this much money going forward for the foreseeable future, at least this year, probably next year as well, as we're just in the early innings of this AI investment. Additionally, Alphabet is adding a new multi-year investment of $5 billion to Waymo. And Waymo continues to build the world's leading autonomous driving technology. If you don't already know, Waymo is offering driverless rides today as we speak, tens of thousands of rides every week in the San Francisco area, and they also have operations in Phoenix. So while Tesla is still talking about and promoting driverless car technology and has yet to deliver a single driverless ride, Waymo is already out there offering tens of thousands of rides. Now, the big difference is that Tesla can achieve this on a larger scale because its technology does not depend on expensive technology like LiDARs and radars that Waymo's cars do, which makes each Waymo vehicle so much more expensive than each Tesla vehicle. And if Tesla can unlock that potential with the current technology, which is cameras only and not LiDAR and radar, etc., that makes each vehicle more expensive, then Tesla can ramp that out and roll that out on a national or international scale. Whereas Waymo, its strategy is more of a city by city and expanding in that way. So the rollout can't quickly expand just like Tesla can, but still, Waymo is out there offering rides, collecting data, expanding use cases, and making progress towards a world with driverless cars. Now, Alphabet has increased its cash flow from operations tremendously over the last decade, up to 105 billion in the most recent trailing 12-month period. And despite these investments, increasing in capex, increasing in employee count, I suspect Alphabet's cash flow from operations will remain robust, even if one of its primary risks come to fruition, and that is losses in market share in search. It is so dominant in search that I suspect it will lose market share given all the rise of all of these large language models and the pending launch of Search GPT. I suspect it will lose market share. But despite that, I don't think its cash flow from operations will be meaningfully downgraded as a result because of other businesses that will ramp up to offset the declining impacts from search if they're not devastating. Which I don't reasonably expect them to be. So Alphabet right now is trading at a forward PE of 19.62, which I think is a cheap valuation for an excellent business with the prospects that Alphabet has in the long term. And you can understand why I've had Alphabet stock rated as my top stock to buy in 2024. And it's still my top stock to buy despite all of the rising risks to the company's search engine business. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.